Welcome back to Trading Hour. As promised, Somnath Mukherjee from ASK Wealth Advisors joins us now to discuss market fundamentals and its top sectoral picks. Good morning, Somnath, and thank you so much for joining us. At the current level of the markets, how do you see fundamentals playing out? Where do you see valuations, and do you see further upside for your top picks or for your top sectors from these levels?
Sure. Good morning, and thank you for having me. Actually, from a market valuations perspective, there is very little in the market that could be termed as value, as traditionally value is known. Most stocks, most sectors are trading at either extremely expensive or insanely expensive levels. So it's very difficult to find spots of value. But where we do find interesting opportunities at a relative value perspective are banks and lenders. Some of the larger banks and lenders have not participated as much in the last 2-3 years in the kind of rally that we have seen in equities. And that's one space where we think that there is a significant amount of relative value possible, especially as some of the COVID-related bumps completely wear off in some areas. Some of the government-sponsored capex-related bumps hit roadblocks on valuations in certain other areas. And investors start scrutinizing some of the smaller companies a lot more, even where they are trading today, compared to what they were when the rally started, say, 3 or 4 years ago. So at a relative value standpoint, banking and financial services, especially the lending side of it, looks probably the most value part of the market right now.
But do you like NBFCs also? Could you break that out in terms of lending? Would it be just the housing finance category? In that, would it be the affordable housing? Banks and financials is a very large, specter. Right. So drill it down a little bit more for us.
Right. So banks and the lending part of the financial services. Financial services today has 3 or 4 different verticals, as you mentioned. There's a lending vertical which comprises banks and NBFCs, and then there is insurance, which is the other big vertical, and then there is a third vertical, which is essentially either market infrastructure or market intermediaries in that third vertical. What I am referring to is the first, which is the lending side. NBFCs and banks are both fairly well positioned for slightly different reasons. NBFCs, because a lot of them are funded wholesale, and we are most likely, in fact, we are almost certainly at the peak, or we have crossed the peak of the rate cycle. And any institution that funds itself wholesale would tend to benefit disproportionately as interest rates fall, as market borrowing rates fall. So that is a fairly large tailwind for NBFCs, especially those that are wholesale funded. Banks, because of 2 somewhat different reasons. One, from a valuation multiples perspective, they're positioned a lot better than the rest of the market is. They simply haven't gone up in the same proportion as a lot of the other patches in the market. And second, credit growth remains a secular compounding story. It's not predicated on massive amounts of growth. So the earnings underlying those multiples are not predicated at the sort of 25, 30, 40% year-on-year growth that some of the other patches are predicated on. And that level of credit growth is very visible in the environment. So put both of that together, we think that lenders are a good patch to be in today.
Understood that, Mr. Patnaik. And any preferences within the lenders? Do you like the PSU names? Do you like the private names? Or some of the private names haven't really performed. And apart from the BFSI space, which other sectors do you like currently?
I wouldn't be able to talk on specific stocks, but I would say across the board, from the NBFC side, preference is for wholesale funded NBFCs. On the banking side, preference is for the larger banks because larger banks have a greater runway or greater ability to expand balance sheet at the expense of some of the others. As it is, there is an RBI-induced slowdown in deposit growth, and hence have the ability to create that secular compounding a lot better than some of the smaller banks. So I would privilege the larger banks and wholesale funded NBFCs on the lending side. Besides lending, the other space where there could be some opportunities going forward are on the consumer side. Early days yet, if we see a certain amount of pickup as some offshoots of or green shoots of data seem to suggest, a turnaround in consumption, especially with some level of pivot towards greater welfare spends coming in from both the union budget as well as the different state budgets across the country, then there could be an incipient opportunity on the small ticket consumption side as well. But that's something that we need to wait and watch and see how they pan out. It's not something that is as obvious and evident from a relative value perspective as lenders are today.
Defense, power, and railways, Somnath, these were the big wealth creators. Where do you stand on them right now?
Three very different sectors. Almost all the investable companies in these sectors have the overhang of a terrific amount of earnings growth underpinning the kind of multiples they are trading at. Will they continue to deliver the sort of returns that they have over the last 3-4 years? Who knows? I mean, that's a bit of an open question, but from a pure margin of safety, relative value perspective, they're certainly not where they were 4 years ago, and they're certainly looking a lot less relative value compared to some of the larger companies, some of the, certainly the banking, financial services pack today. Many of the defense companies are discounting, for example, earnings growth that are way disproportionate to, say, what India's growth in defense expenditure is. Just as a broad macro backdrop, defense expenditure in India grows at a roughly the same pace as nominal GDP, about 10-11%. Defense capex, which is really the revenue stream for all the defense companies, also grows at the same pace, if not a little lower, depending on the year, depending on whether there are pension liabilities to be adjusted and so on and so forth. So you're talking about a space where the industry revenue grows at a baseline of 10-11%. Now, obviously, there is a lot of import substitution plays that are on, but many of them would pan out over long periods of time. And it's not as if things in defense are so easy to replace instantaneously, an offshore platform with a local platform. So some of the earnings growth predications underpinning the kind of multiples that defense companies are trading at may not be, justified anymore. Exceptions apart at a sectoral level. So yes, they don't certainly look like having relative value as of this point in time.
Okay, thank you so much for joining us and giving us a detailed view as far as markets as well as your preferred sectors. Time now for a short break on